Hey everyone, welcome back to the Daily Gold Podcast. Today we're chatting with Dave Skarica. He's the editor and publisher of Addicted to Profits, and he's also the editor of Gold Stock Advisor, published by Newsmax. Dave, it's been a long time since we've had a public interview here. We were just catching up off air. Let's get right into it. Dave, you're not one of these fanatical doom and gloomer types, but why don't you tell our listeners the problems that you see in the market right now, specifically with what's going on in equities and junk bonds?
Well, I think the problem is I have no problem believing that at some point there's going to be another secular bull market, meaning a move of 15 to 20 years. And a lot of people think because the S&P has broken out to new all-time highs in nominal terms, of course, nowhere close in inflation-adjusted terms, we're seeing like a breakout like 1982 and that sort of thing. So I think my argument against this is, number one, valuation. Our valuations aren't terrible. We're 14, 15 times earnings on the S&P. And, at the bottom, we probably got down to like 12 times earnings. But a single digit, usually sometime in the secular bear market, happened in 1974 and in the early 80s, or happened in the late 40s. You need that kind of valuation to really, really hit rock bottom. We probably need one more downturn in the market for us to get to that kind of valuation. So number one is valuation. Number two is, I'm usually not one who looks at economic stats and all these sorts of things, but I think the problem I have is you need some kind of deleveraging. Again, in the 70s, people really got deleveraged. There was a high savings rate by the end of the bear market. Same thing in the late 40s. And of course, now with this recent rally, we're just reinflating old bubbles. Housing's gone back up in a lot of cities across the states. Real wages, inflation adjusted, or actually it's something like 6 or 7 year lows. Like actual amount of money that people have in disposable income has not moved in 7 or 8 years, and savings rate is back to the 2006 lows as well. So again, we're just kind of reinflating the old bubble with low rates, and then we have these mini bubbles forming everywhere. And if you look at REITs, the housing stocks, got a big move from their bottoms. If you look at all of the large cap, like the J&Js and the McDonald's, and these stocks have soared and gone way above the 2007 highs. So I think that's a chase for yield. I think rather than kind of the high growth stocks, you look at something like Apple's trading at a single digit PDE, and rather than people chasing those stocks, people are chasing the kind of stocks that have some yield. It's actually almost in a way the polar opposite of 2000. So I think that's the problems I see right now in the market. And I think we need another downturn or shakeout in the market. Of course, the sentiment's now totally turned as well, where everybody thinks the problems of the financial crisis are over and we're going to start a new boom. And obviously, another problem would be to see this is not like the 90s where we had this booming economy and low unemployment. Like participation rates are at 30-year lows. Youth unemployment is a lot closer to 20% than it is, 7 or 8%. And so there's all these problems with it as well. It's basically just bent on cheap money and low interest rates. And because of actually the somewhat depressed economy, companies have been able to keep costs under control and therefore keep their margins high. And that's what's keeping valuations low rather than top-line growth. So I think these are all kind of my problems with the stock market right now. But I think if you look at the positive, and you can expand on this too when I finish this, I think the positive, now we've gotten back to more what I think is historically normal, in that we have the precious metals complex acting inversely to the stock market. Where gold, and people think, all the inflation risks or doom and gloom risks are out of the market now. So people have sold gold and precious metal stocks and gold and precious metals themselves, and people have piled into the S&P 500. I think now we're set up where we can be more like the 2000 to 2002 bear market, where gold and precious metals can move higher and the stock market can move lower at some point. So I think that's the positive side of this rally, kind of maybe going higher than anybody thought, is we're set up for the more traditional role as gold as a hedge.
Dave, I'm just thinking, what is going to be? Is it going to be inflation or deflation that really drives the end of this bull market in precious metals? And I guess you could also say commodities, because if you go back through history, I'll just do this quickly. 1930s it was deflation. 1970s every time it was inflation. But interestingly, in this cycle, I believe we've had three cyclical bulls. We had the first one in 2000. It began in late 2000 or 2001. You could say that was kind of deflationary driven because after the tech crash, there were some deflationary fears, and the Fed cut interest rates way too aggressively. 2005, that was actually driven by inflation because commodity prices, as precious metals consolidated from '04 to '05, commodity prices actually kept going up. And of course, 2008, that was deflationary driven. I always thought it was going to be deflationary driven, this last one. But, I mean, looking at things right now, the CCI has not made a new low. Treasury bonds have performed very well, but really all the money has been flowing into the stock market and junk bonds. So I'm more this time. I'm thinking maybe we are going to see the stock market and things just get overheated, and then money that's been in these other places starts to get concerned and starts to take advantage of the opportunities in these inflation types of investments. I guess, do you agree with that it's going to be inflation is going to be the trigger for the next move, or what else might need to happen for this next cycle to begin?
Yeah, I think that I've actually always been an inflationist because I thought that they would always fight deflation by printing a lot of money, and that would end up leading to higher prices. And I believe that we're in the inflation cycle. I think we're like where we were in the 30s and 40s and 70s, where we're in a 15 to 20 year up cycle for inflationary assets, and obviously there's going to be lulls and pullbacks along the way. So I thought it would be inflation. I think the last bust will end in deflation, because what always happens is when you have one of these inflationary moves, which causes the last bust, the reaction is actually to finally increase interest rates, decrease the money supply like Volcker did in the early 80s, and crush that inflationary move. So I think that's how it will end. But no, I think if you look at the sentiment point of view, what happened is, we had all these risk assets moving up together in the 2000s. And about 2 years ago, we started getting a disconnect, and that's really accelerated in the last 6 months, where people are now, because they think good times are here again, are into equities, and these kind of inflationary hedges like commodities and precious metals they're selling out of. So what's interesting is, for the first time in a long time, we have, if you look at the sentiment indicators, we have very positive sentiment towards equities, and we have very negative sentiment towards things like commodities and precious metals. So I think we're kind of setting up for what you're talking about, kind of an inflationary move where maybe all this money finally starts to kind of, like seep itself into the economy, and we get some kind of inflation or commodity prices moving higher. You got to remember too, from a supply demand standpoint, with this recent bust, it's very difficult to raise money in the commodities markets right now to start projects, to get projects going, to get things into production. So you're probably going to see that disrupt the supply chain at some point as well. I think no one's actually really taking that into account right now. The fact that when you have these terrible capital markets in the commodity stocks, that's actually might add to kind of the inflationary trend as well. So yeah, I definitely think it's actually going to be much more inflationary here going forward. And the kind of thing, when I hear that the precious metals bull market is over, and I hear things about the commodity super cycle is over because China and India are going to see like lower growth rates going forward, I kind of like to see. I like to hear that because I'm a contrarian.
Right, and also, how much of an impact do you think monetary policy, outside of the U.S., is going to have? Because obviously we all know what's going on in Japan. Europe just cut interest rates, and they're dropping hints that they're going to do QE at some point. Obviously they'll have to. And looking at, there's a number of other countries. Australia, Poland, I think South Korea, India, Brazil. There's many others that have been cutting. Russia is another one that have been cutting interest rates or started to cut interest rates, I think, in the last month or so. I mean, Dave, do you see that having a positive impact on commodities?
Yeah, I think no one's taking that into account, that the media and lots of times investors as a whole are so U.S.-centric. They're talking about, is the Fed going to stop buying bonds? But they're not talking about that Japan is buying almost as many bonds as the Fed. They're buying $75 billion a month, as opposed to the Fed, which is buying $85 billion a month, even though the Japanese economy is a third of the size of the U.S. economy. So, you got Japan buying, you got Europe buying, you got Britain still having their quantitative easing. Like you said, like Europe still got the QE kind of foot to the pedal because they want to keep those Italian and Spanish rates low. Australia, which is one of the few countries in the world that had real nominal interest rates, has now started to cut them too. So I think, you have to take that into account. The U.S. is only about a quarter of the world's economy, and when you have essentially, half the world on a loosening monetary policy, that also is inflationary as well. It's not just money printing in the United States per se, which is going to lead this. And I think what makes it interesting is, when does this filter in? I think one reason we haven't seen the inflation we thought we would see with all this QE is that, a lot of that money hasn't gone back into the economy because it's just sitting on the Fed's balance sheet or sitting on the European Central Bank balance sheet. And the question is, at some point, that money will probably re-enter the system, and that's when you're going to get inflation. And I think, because the U.S. is still the reserve currency of the world, I think what's going to happen is that's when you'll feel the inflation, because at some point the yen will stop going down. Like, it still may go to 150, but at some point it's going to stabilize to a lower level. Europe, really the 130 or so, that the euro is not falling out of bed. I think once the austerities stabilize the economies in Europe, you can see the euro strengthen again against the dollar. And obviously, if we're near the bottom of the commodities, the Canadian and the Aussie dollars can kind of maybe go a little lower in the shorter term, but they'll at some point stabilize as well. So what I'm saying is, I think at some point you could see the U.S. dollar resume its kind of long-term downtrend and move lower. And, if this kind of cheap money boom blows up again, that could be the catalyst from it. And it could be the opposite of the financial crisis, where because maybe, commodity prices are rising and some of these other places are stabilizing and the U.S. is having another bust, that actually could coincide like a lower dollar, during the next downturn. So I definitely think that all this printing of money around the world is going to lead to higher commodity prices. But again, we've also set ourselves set ourselves up for, at some point, the U.S. dollar going down could also be the catalyst of the result of all that sort of money printing. Because we're definitely seeing a currency war with everybody printing money. I think because of, printing money to bail out the financial system, or printing money to save Italy and Spain, a lot of people have seen this printed money not so much as a devaluation method, but rather like something of a necessity to keep these things afloat. Now, the Japanese thing kind of really turned the corner, and we're going to really see a lot of currency wars going forward. I believe the U.S. started it, because with the TARP program and with, obviously the first round of QE from the Fed, that what happened is the U.S. decided essentially, to somewhat devalue its currency, and then now everyone else is kind of fighting against them by devaluing theirs.
Right, and these other nations and those policymakers are seeing what happened in the U.S. and they think that it can work. I mean, it's just amazing the short memories that people have. I mean, we have this ballooning of deficits, massively inflationary monetary policy, and commodities reacted, and then we started to get a little tighter policy coming from the emerging markets, and naturally gold and silver and other commodities, they weren't going to be able to sustain those high prices, and they've corrected and inflationary fears have receded, and now all the money's moving into, as I said earlier, equities, junk bonds, the chase for yield that you're talking about.
Yeah, and I think that's been a major problem for the commodities market as well. Is that as long as things are moving higher in gold, people don't care that you don't get any yield off it. But the problem was once gold, once it kind of lost the momentum, and you've had the stock market doing well, that shifted everything in the chase for yield. That gold and precious metals have lost 10%, for example, and they'll say, oh, well, I got to get into a junk bond, or I got to get into something that yields something, and then interest rates are obviously almost zero at the government level, so it's just causing this kind of bubble in the chase for yield, and that at some point is going to turn around and blow up in their face as well. And again, like I said, that has created a bubble in go look at the stock charts of J&J or McDonald's, and I'm about to sell my McDonald's, by the way. I bought McDonald's at 54 back in 2009, and now it's over 100. So it's if you look at the stock prices, it's the opposite of 2000, where now it's this kind of the seen as a lower risk, higher yielding stocks are really, really moving significantly to the upside rather than the growth stocks. And I think that, again, that was the problem that commodities ran into, is that once people saw that, these high yielding stocks are moving, plus they have some yield, it kind of pulled a lot of money out of the commodity sector. And, to be blunt, we have seen slowdowns in China and India, so that gave people another excuse to kind of get out of this kind of commodity trades as a whole as well. But I really think this is just a consolidation in the long-term bull market. In terms of the stock market and being a secular bear market, if you go look at the late 70s, you'll see actually the S&P made a number of new all-time highs, but then usually followed that up with a decline. It was like a choppy new all-time high. It wasn't the out-and-out breakout until 1982. So I think that's kind of what we're seeing here. Remember, the Dow went over 14,000, way above its 2000 high nominal terms back in 2007. So, we could go to 16 to 17,000 on the Dow before this all is all said and done, but that does not mean we're still in kind of a new secular move. I still think we're going to have one or two more down moves before we see kind of a new secular bull market. And again, I think the keys to watch for that in a longer term move, meaning a 15, 20-year move, are dealing with the problems. Actually letting interest rates go higher, deleveraging more debt, people starting to save again. I think these are the things you actually want to see before we see a long-term move, rather than just trying to reinflate the real estate bubble, or one thing that they've done now is real estate, reinflate the stock market bubble. So you have capital gains taxes and all these kind of things. So I think that we want to see the real problems taken care of rather than these short-term solutions. And by the way, that's why I'm quite confident that precious metals will bottom here. In 1974 to 1976, there was a 40% decline in gold and precious metals. Many of the stocks fell 60 to 70%. Very similar to what's going on today. And 76 was similar today because, again, people thought, you're out of the 74 recession, and unemployment then fell from over 9% to back under 6%, and everyone thought that everything was stabilizing and coming back. And then, of course, 4 years later, gold almost went up 8 times in value, and unemployment was back in double digits, and the Dow was, back over 20% lower in nominal terms from its 76 high to its 82 low, and actually in inflation-adjusted terms fell much more. And I think that's kind of where we are today. Meaning that, I think that this is kind of like this false recovery, and then at some point it's going to turn around. At some point you're going to see the resumption of the down leg. And I don't think, because we have the leverage, we don't have the leverage of 2008, so I don't think it's going to be a crash. I think, actually, this could be very similar to 2002, the 2000 to 2002 bear market, or the 80 to 82 bear market, where it's very grinding. It could be 2.5 years in length, and a lot of up and down moves, and just kind of grind lower, and almost be like Chinese water torture rather than an out and out crash.
Right. Well, Dave, on that note, we have to end, but it was great to have you back, and thank you so much for your time, and look forward to doing another interview with you soon.
Yeah, I look forward to being there.